Good morning, everybody. Thanks for joining us again today on our weekly trade and tariff briefing. My name is Rich Israelson, and I'm the Chief Revenue Officer for World Trade Center Utah. And I have the pleasure of facilitating today's conversation. If you're here for the first time, this is a weekly webinar series that's intended to provide you with the latest information around trade and tariffs. And we have the opportunity each week to have a featured guest from a different part of Utah's economy or the U.S. economy. And today we're pleased to be joined by Glenn Metzger, who's the Vice President of Marketing and Sales at OOCL. But before we do that, I'm gonna turn it over to Taryn Marriott, also with World Trade Center Utah. Taryn is sitting in for Ben Collender today. And she's going to give some updates on the WTC Utah tariff dashboard, which can be found on the website. And as anybody who has been following that or been referring to that over the last year and a half, you know that it is we keep that up to date in as real time as possible. And Taryn's been right at the center of that for the last several months, doing a great job on it. So Taryn, there's been a lot going on the last couple weeks in tariffs. Do you want to walk through some of the changes that we've seen?
Yes, thank you, Rich. It's fun working on this with Ben in the back end, and it's nice front facing and being able to explain what's been happening these past few weeks. And there has been a lot. Starting on this first line, as you can see here on our tariffs dashboard, the global 301 tariff, which ranges from 10% to 12.5%, went into effect on July 24th. And so the goods targeted are from countries not enforcing forced labor standards. And there are lists of exempted goods, and we have that linked on the dashboard, as well as specific links to the 13 countries that have country-specific exempted goods. And we also saw that hours after the tariffs went into effect, small businesses filed a lawsuit challenging the forced labor tariffs. We see that also Brazil had their Section 301 tariff go into effect on July 24th. And this tariff is a 25% tariff. And there are as well exempted goods listed. We are also watching the Section 301 tariffs on excess manufacturing capacity. So the public comment closed for those on May 20th, and they are targeting a list of specific countries as well. And the Section 301 investigation on Germany targeting pharmaceutical goods has public comments open until August 10th. Next on our line, we see the Section 122 tariffs. So Section 122 tariffs authorize the president to impose that temporary surcharge for up to 150 days. And that time frame ended on July 24th. And so the Section 122 tariffs have ended. We come here on July 23rd, where we have an update from the US, Mexico, and Canada agreement. So, giving context, USTR released a statement on July 1st that the US, Mexico, and Canada did not agree to renew USMCA. And on July 23rd, Ambassador Greer met with Mexican President Claudia Sheinbaum for their third bilateral negotiating round. So, the next round of bilateral negotiations with Mexico is in Washington, D.C. in September of this year. And these discussions are highlighting the urgency of growing North American manufacturing and strengthening regional supply chains. And Canada has not been mentioned or included in these discussions. And this next line item on the tariff dashboard is not a tariff, but it relates to critical minerals and is relevant to Section 232 tariffs. So on July 20th, President Trump signed an executive order tightening the required waivers to purchase critical minerals from foreign suppliers. This places greater responsibility and requirements for defense contractors to strive to domestically source critical minerals used in the fulfillment of contract awards. And these waiver restrictions go active on July 1st of 2027. On July 20th, a 50% tariff on Canadian imports was announced that goes into effect on August 19th. So, giving some background to Section 338, This is a tariff that authorizes the president to impose duties on a foreign country when the country is acting discriminatory against the commerce of the United States. So, in the proclamation, um, we highlight specific goods and practices that were deemed as unfair and justification for the tariff. So here we can specifically see motor vehicles, alcohol, and dairy. And this press release and the specific information that's given in there explains why those items were chosen as a discriminatory action and background justification for Section 338. And there are goods excluded as well, including energy, potash, critical minerals, and as well carving out existing goods already tariffed with the Section 232 tariffs. This line item, we see as well that USTR established a program that decreased tariffs on aluminum to encourage new investment in U.S. production facilities to produce primary aluminum. So this applies to entities that are seeking to build aluminum production facilities domestically. So the current tariff on aluminum is 50%, and approved participating entities receive a 50% discount off that rate. So this is reducing their tariff to 25%. And there are limitations, and construction has to be happening by 2029. And so that's up to the discretion, but this is to encourage domestic production of aluminum. And that is it for the tariff section, but we'll come over here to our deals dashboard. And we see that on July 23rd, the USTR issued a statement about uncertainty in our relationship with the European Union in the Turnberry Agreement. So kind of high leveling their reasons for this are a $1 billion fine on Google, and that the EU is placing investments that pose competition to US companies. And our last deal update is Jordan. On July 21st, Ambassador Greer signed the US trade agreement on reciprocal trade. In this agreement, the US agreed to lower trade barriers. So our tariff for Jordan was lowered from 20% to 10%. And Jordan committed to significant purchases of US goods and to eliminate import barriers. And those are all of our updates for the deal side as well. And if you have any other questions, we'd love to help you and your company specifically with tariffs and understanding more, but we're going to send that back to Rich. Thank you.
Fantastic. Thank you. Thanks, Taryn. That's a lot. There's a lot going on right now. And as Taryn said, we are at World Trade Center Utah. We're here to help make sense of those to the extent of the research that we do to pass that along. So thanks for that overview, Taryn. Very well done. Okay, it's my opportunity now to send it over to Glenn Metzger, again, the Vice President of Marketing and Sales at OOCL. We really appreciate what OOCL does in this community, and look forward to hearing from Glenn. So, Glenn, take it away.
All right. Thanks, Rich. Hopefully everyone can hear me well. Just want to give you some background first on what OOCL is and where we are, what we're doing. So basically, we are an international shipping company. We were established in 1969. Our global headquarters is actually based in Hong Kong. We're actually listed on the Hong Kong Stock Exchange. Our core business is actually container shipping, but we also dabble in logistics and supply chain solutions with our sister company, OOCL Logistics. Since 2018, we've been part of the Costco Group. So we do operate as a dual brand or a separate entity. So OOCL is its own entity. And our North America headquarters is actually based here in South Jordan, Utah. We operate over 200 services globally. So we have exposure to the global environment. And today I want to talk more or focus entirely on the Trans-Pacific services, what's going on in that market, and give you some updates on where it's heading, and just go from there. So as far as the Trans-Pacific market goes, the year actually started slow. We knew this, we saw this happening. The Lunar New Year was an early Lunar New Year. So many of the factories in China and Asia actually closed early, and some actually stayed closed longer than normal. And this had an impact on volumes. We did see trade down pretty much for year on year through April. But then May happened. Now we know that there was things going on in the market or in the world. We had the Hormuz crisis. There was a focus on fuel. There was also a focus on the overall environment that was happening with tariffs as it related to tariffs. So in May, there was actually a surge. So what we saw was a 16.3% surge in volume on Trans-Pacific imports. That actually drove a substantial amount of volume to the West Coast to start. When we looked at the West Coast, actually, the West Coast took the brunt of the volume, where year over year, it actually grew 28.8% in May. That's a substantial increase. And actually, many of the ports on the West Coast experienced record volumes. They were reporting record volumes. It was substantial. The U.S. Gulf increased 19.7%. So that was a substantial increase. And the U.S. East Coast actually only saw a 0.8% increase. But later in June, you saw that then rise up to 27.1%. So there was somewhat of a delay. So there was a feeling that May was caused by what we sometimes see as what's called front loading. With the tariffs in place, that Section 122 or that temporary tariff that was set to expire July 24th, there was a concern about the Section 301, what it would entail. So there was almost kind of a front loading process in place where many shippers would look to beat the clock or beat what was possibly happening. But also you had a fuel crisis starting because of the Hormuz. Over 26% of the volume of fuel in the market was actually being disrupted. That created a whole chain of issues. Because this industry or the container shipping industry is very dependent on fuel, fuel surcharges started to play a factor. Many customers saw that as a rise in costs. So there was an expectation that as the crisis went on, the issues would continue and the cost would get higher and higher. So it was, again, another factor that may have caused beat the clock. Also, many products are made from oil. So there was a constraint on product development or products supply. And that was creating some issues where many customers had concerns about not having products going forward. So they wanted to stock up before the crisis really started to hit. So again, we saw this happening. And in May, the market again grew 16.3%, a substantial increase. It was unexpected. And what we saw was many shippers looking to fill their orders. So again, demand exceeded capacity, capacity being the available space on ships. So there's only so many ships that are available. So basically, many customers or many shippers had to result in paying more or moving their cargo at higher rates to get on ships and to make sure that their product was moving to the destination. So where did all this originate? It wasn't just overall. What was interesting was it originated mainly from China. When you look at northern China, eastern China, the surge was 34.3%. And then when you look at southern China, it was 29% in May. What was interesting was Japan, South Korea, of course, they're still shipping volumes, but they actually experienced a decline during that time. They had a 10% overall decline. The Middle East, of course, was impacted by a decline of 36.1%. And then when you look at South and Southeast Asia, the volumes were actually still consistent with a growth pattern that we were seeing for months, and that surged 10%. So again, the volume was there. When we talk about South Korea or Southeast Asia and South Asia, The top three are Vietnam, Thailand, and India. So again, all this is happening, and that was the explanation. But what's interesting is as you move through the months, you start to get data from different resources. The U.S. Commerce Department has a report that's called the Retail Trade Inventory to Sales Ratio Report. And in that report, it actually shows that sales have risen since February. So the U.S. consumer is actually buying. So on top of everything else that's going on, we are seeing in the marketplace that a lot of these volume is because inventory is going down, or inventory is at a level that's being sustained because there are sales happening. So again, the tariffs and fuel were a factor, but it wasn't the only factor for that rush. We did see that the U.S. consumer was still there. Now, in the whole scope of the shipping industry, we do talk about peak season. This was an early peak. Usually, our peak season happens between June, July, or late July to August, and then into September. Having it in May creates that early peak season, which was unexpected. Now, what's interesting is that that peak season is continuing. Now, the highest peak was actually in May, but we've seen this continue into June. The volumes are still high in June. They're still high in July. And what we're seeing in forecasts in terms of August, it still remains high. But basically, May was the actual peak. So when we look at all the overall numbers, the top 10 commodities, which make up 73% of the overall volume, the volume's strong across the board. So all these commodities, plastics and rubbers, furniture and lighting, machinery, e-goods, automobiles, metals and related products, textiles, fashion goods, wood and paper, foodstuffs, all of those commodities are actually at a volume that's significant and really helping with the overall volume. So what we did was understanding how everything is going. We needed to reach out to our customers to really understand it. And again, many of our customers are major retailers, the largest retailers in the U.S. Talking to them gives really good insight of what's going on. Understanding what we read in the news and see in the news about the U.S. consumer strength, hearing from them really gives an insight of what their forecasts are going forward and what it looks for the industry going forward for the rest of the year. And what we heard from them is that the U.S. consumer is value focused. It is a still value focused group. But what's really driving the U.S. consumer is what they call or refer to as sales moments. They are driven by that. And they're moving away from what we would call wants to actually needs. And it's interesting that we're seeing a lot of interest in replacements. Now, when you talk about housing, you look at housing and there's the 7-year itch where every 7 years you kind of want to look at another house or move into a new house. Well, that happens in certain commodity groups like kitchen appliances and technology, where after 5 years, the U.S. consumer is usually looking for a replacement. And that's actually happening right now because there was such a huge demand or a huge surge 5 years ago to buy everything to rack up sales that now we're at the stage where there's replacements. There's a need for replacements, and we're seeing consumers go after that. We're seeing consumers buy that. So a lot of the volumes that we're seeing, again, is not only your normal patterns in terms of setting up for back to school or holiday seasons, whether it's Halloween or Christmas, but it's also replacing inventory that's being sold. What we also see is that the U.S. consumer is technology driven still. So the newest and latest is still there. It's still grabbing consumers and they're still buying. So again, those products are moving and they're moving off the shelves at a decent rate. So getting to the tariff side of things, back in 2025, many shippers were front loading to beat the tariffs. We've now gotten to the stage where I think that what we're seeing or what we're hearing is that these tariffs, the recent Section 301 tariffs, 10 to 12.5%, that's not expected to have a significant impact on U.S. container volumes. Surprisingly, it's there's a shift that's happening, at least for the larger retailers, the larger shippers. There seems to be a shift that those are just the cost of doing business. What we're also seeing is that the bookings remain strong through August. So when we look at our booking window, there's usually a 3 to 4 week booking window before actually shipments happen. That is strong. What's also happening is there's more capacity being moved into the West Coast as in forms of extra loaders because there's such a volume surge. There's such a demand that the capacity has to catch up to the demand, and that's where we're at. So after August, there's really no crystal ball, but there are, of course, people in the market, in the news cycles that do have crystal balls, or they at least consider them to have crystal balls. And what they're projecting is that after this has calmed down, that there will be a softening. There will be a softening of volume coming into the U.S., but it's going to remain stable for the rest of the year. So finishing out 2026, there's an expectation that we will not see a drop unless there's another black swan. But pretty much overall, we see a softening to a stabilization of imports. Now, I have a few more minutes. I will touch on outbound as well. Outbound is another factor that the U.S. plays a very important role in. When we look at outbound overall, it has been down slightly since last year or over last year. The main products that we are exporting outside of the U.S. is agriculture products, general cargo, waste paper, resin, vehicle parts, and chemicals. Those are the top commodities that you have. Now, agriculture being the biggest one, we're right now in an off season. So usually between April and September is the off season for major commodities like soybean, corn, and other major agriculture products. But what we're seeing is that it's too early to actually say how that will evolve, how that will look when it comes harvest season, which is usually starts around late September and moves through December into possibly even January. But basically that hasn't been said yet. So we haven't really seen what the expectations of that will be. But China is a wild card. China right now for agriculture is mainly bulk focused. They're a major buyer of U.S. agriculture. So containerization is a little bit different story, but basically it's still a wild card. It's still trying to be figured out. Waste paper, a major export for the U.S. That product actually is a very good indicator on where things are going because much of the waste paper that goes into Southeast Asia to be processed into wood pulp or into paper pulp and then moved into China helps build the boxes that you see your shoes come in, the shirt inserts or the male shirt inserts that you get when you buy a shirt. There's a cardboard insert. All the factors that use paper, when we see waste paper moving at a certain degree, that is giving us insight into what's coming. And right now, those volumes are very stable. Also, the other factor is resin. Resin being a manufacturing product or basically a product that's used to manufacture finished products, whether it's toys or whatever it is that's made out of plastic. A lot of that resin and a major shipper of resin is going to China, and that is also being looked at as well, but that's been stable. Chemicals, also, we haven't seen much up or down on that, but basically that's been stable as well. And that's where we're at. So when we look at outbound, the major countries that are the focus of the U.S. exports, China, Vietnam, Japan, South Korea, and Thailand are all your major countries that are accepting exports from the U.S. With tariffs or reciprocal tariffs in place, a lot of that is subject to being impacted. But right now, what we're seeing is that the most impacted or the most wild card that we can see is the agriculture side of things is still up in the air as it relates to containerization. So that's it from an inbound, outbound perspective. Quick story. Hopefully that gave you some insight into what's going on in the market, where we are, where it's heading, and that's it. And I will say that Utah is well positioned. We do have this network that's been growing. Having two rail hubs established in Salt Lake City has really opened the doors for growth in this state. I think that we're well positioned to capitalize on anything that we see with what's happening in the market. And that's it. So back to you, Rich.
Glenn, thank you. Thanks so much. That was fantastic. So I've got pages of notes here from the last 15 minutes of your presentation. And feel free to everyone, if you want to drop any questions in the chat, please do. We've got just about 3 minutes left. Glenn, I want to clarify, talking about that outbound, that was very interesting, the waste paper and resin
Right,
specifically.
right,
And again, we're again, everybody's trying to get a crystal ball and 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 no, but nobody can really give a crystal ball. However, that waste paper and resin
right.
information feels to me, from what you said, that's about as good a crystal ball as is out there, based on not beyond 26, like
Correct.
27, even early 28, based on those on that. Is that a fair comment?
So it's fair, but there's also another little caveat that has to be explained there. The waste paper and resin market are also supplying the domestic markets. So basically,
Okay.
when we talk about international, if the domestic markets are surging as well, that may give a miss read. But basically, you have to look at all those factors to really figure out what's going on. But it's interesting with the waste paper. I know a few major waste paper shippers, and they are strategically placing themselves in the middle of factory areas. So basically, like your shoe box, if there's a factory that has shoes that's making shoes, most likely the waste paper will be closely or near that factory, which is very interesting, which I found out recently, but I think it's a very interesting fact to see how they position themselves.
Yeah, yeah, absolutely. And then the other question, as it relates to that replacement calendar for the U.S. consumer, and that 5 year turn,
Yeah,
and we're right there. That's that COVID surge,
right,
2021. We're right in the middle of that. I mean, we're smack dab in that 5 year window.
right.
Um, how is there? You said it would, the expectation is that it would soften, not
Mhm.
till presumably it looks strong through 2026.
Correct.
Um, how severe? I mean, again, I know this is a crystal ball question.
Mhm.
How severe do you think that softening might be once people go through that replacement process?
So the second quarter, I think, is our peak for this year. The softening, I think it will still be growth mode, so it'll still be better than 2025. I don't think you're going to see a dramatic drop unless there's a black swan event, unless there's something that happens, that the US dollar crashes or whatever it is
Mm.
that can happen. Because that's what's interesting about this industry lately, is that we're always dealing with black swans. There's always something. And the Hormuz is what it is this year, and then next year it'll be something else. So we're always working through that. But the U.S. consumer seems very resilient, with all the credit that's out there, or that's being utilized. The U.S. consumer is still resilient, and we're seeing that in the numbers, and our customers are seeing that.
Yeah. Yeah, it is. It's pretty remarkable given all of the things that have happened over the last, call it 24 months.
Mm.
The resilience is really notable of the U.S. consumer. Totally agree. Listen, we're at time. Boy, I have other questions, but Glenn, this has been really terrific. Okay, hold on. We're going to do one more. Jeremy Guzman just sent in Is there any relationship with global bond markets and how that will impact business with the higher yield curve that is that going to impact corporate operations and possibly import-export activity? Glenn, any thoughts on that as it relates to the
Yeah.
global bond
I
market?
mean, you have cash expenditures, you have investments, that all is related to this. So again, that will play into the area of whether customers are really willing to take on risks or shippers willing to take on risks. I think that's where the effect is on companies is that it increases their risk. If there's a negative with bond markets or a negative where it affects their cash flow or anything like that, I think that's where we're seeing a possible impact. But I don't think that would be something that would be floated at the top. I think that would be more in the undercurrents,
Hmm.
basically.
Yeah. Justin, thanks for that question. It's a great question. Um, okay, they're starting to come in right at the time we got to jump off. Insurance costs in the future. Can you give us 30 seconds on that from Don McMillan?
So I'm not an expert in insurance, but I know that insurance does play a major role in uh, global shipping. So a lot of the importers, exporters, they do have to take on insurance for their shipments. If it is going through a war zone, there's increased costs. Again, I'm not a insurance expert there. So
Okay. Okay, Don, thanks. That's a good question, and it may be something that we'll consider for a future webinar is zeroing in on that subject as well. Hey, everyone, thanks for joining, and Glenn, thank you so much for sharing your expertise. Taryn, thank you for all the work you're doing on the on the tariff website, and feel free, everyone, to reach out to us at World Trade Center Utah to with questions that you may have, ways that we can help you. Visit our website, and we'll talk to everyone next Friday. Thanks so much.
yeah. Thank you,
Have a
everyone.
great weekend, everyone.
Bye.